Thank you, Andrea. So welcome everybody. We're going to be talking about investing basics today. We have a lot to cover. So buckle your seats, be on the lookout for bears and bulls, and we'll be on our way. So Andrea, if you want to go to the next slide, please. Okay. So my name is Sasha Grobinstetter. I am one of your facilitators and educators today. I work for the University of Illinois Extension, and I am housed out of Grundy, Kankakee, and Will counties. Fortunately for our colleague, Nikki, Giannicola Shanks, goodness gracious, she is actually out on maternity leave with her new baby. So she did help participate in this webinar and put it all together, but she is not with us today, but she is with us in spirit. And then Andrea, I'll have you introduce yourself.
All right, thank you, Sasha. Again, we're sad that Nikki's gone today, but she helped a lot with the content for our webinar, so we want to thank her publicly. We also have tons of people in the chat, so make sure to check out all our co-hosts in the participant list. You want to check that out. My name is obviously Andrea Pellegrini. I'm sure you've heard me on all previous webinars, and you heard me earlier today. I run the University of Illinois Systems Student Money Management Center out of University Bursar. So today I am in Urbana, and most days I'm in Urbana in my basement right now, thanks to the pandemic. However, sometimes I go to Chicago and Springfield in pre-pandemic times. I also want to remind everyone, don't worry, we are recording this and we will make the recording available later on our YouTube channel, as well as sending a direct link to anyone that registered today. So if you forgot to register and you guys just got in through a link that someone sent, make sure to register so we can get that information to you after the webinar concludes.
Great, thank you, Andrea. So we just want to know where you're logging in from, what county or state are you logging in from today? If you could put that in the chat, and I'll look at it right now. See, Edgar, Illinois, Kankakee, Champaign County, Cook, Colorado Springs, it's lovely. Denver, Colorado, Minnesota, Champaign, McLean, Champaign, lots of champagnes today. But keep those going in the chat. We want to know where you're coming in from. We'd love knowing where you're coming, especially if you're coming from one of our co-host universities as well. So, let us know that as, too. So, ooh, California, how fun. Awesome. So we do have a disclaimer. So we just have to let you know that the Get Savvy team includes educators, not investment advisors, brokers, or other investment professionals. We cannot provide investment advice or answer specific questions about a situation. This presentation is going to cover basic key terms and concepts to help you begin navigating your own investment decisions. We also know we have a large community of learners that love to share their thoughts, opinions, and experiences, which is really great. And we don't want to discourage that. However, investing is a really complicated topic, and you cannot guarantee understanding with a single comment or a few comments. So everyone should just be really wary of any kind of advice given in the chat today, and always do your own research and, and consider talking to a financial professional before taking any kind of action like investing. So just want to let you all know that before we move on today. So Kathy, if you wouldn't mind launching our poll, we just kind of want to know what brings you to our webinar today. So are you coming in just to check out the information? Are you maybe looking to invest for the first time? Do you have some information but just looking for more? Or you're a pro investor and you want just to see what other information or knowledge is out there? So we're about halfway through our attendees. If you can't put it in the poll, please feel free to put it in the chat. We'd love to hear if you can't, access that poll piece, but we just want to know where you're coming in from, just kind of so we get a feel of who you are and you get a feel of who we are as well. So we're gonna probably give it like 10 more seconds, get that poll information in there. And looks like a lot of people are just checking out the information for the first time, and we're really excited about that. So we have lots to share with you. So again, we'll get moving. But we kind of want to talk about our learning objectives for the day. You're going to be hearing a lot of key terms and jargon, and we just want to kind of have you be familiar with the words. We're going to be having a discussion about the time value of money later on. We're also going to be having a talk about basic investing concepts and methods. We're going to plan to explore risk tolerance and kind of like some investing strategies that a lot of people are interested in. And then of course, we're going to give you a nice summary to kind of wrap it up and kind of help you through your day. So I'm going to hand this over to Andrea, and she's going to talk to you more about some terms to know.
Thank you so much, Seisha. So again, we want to make sure everyone's on the same page when it comes to investing basics. So we're going to define what investing means, at least in the sense of today's webinar. Typically, when you hear someone say they're going to invest in something, they're exchanging something of value with the expectation of getting even more in return from that transaction. In a financial aspect, you might expend money with the expectation of achieving a profit or material result by putting it into financial plans, shares, or property, or by using it to develop a commercial venture, like opening a business, being an entrepreneur. So we want to make sure everyone's on the same page with that one. We also want to remind everyone that the stock market is not the same as the stock exchange. Even though they're used interchangeably, it's important to recognize the very subtle differences between the two. So the stock market is a more general term referring to the investors that buy and sell securities like stocks and bonds at one or more of the many stock exchanges that exist around the world. So just be mindful of that as we talk about that, or as you hear other people talk about investing in the stock market or stock exchange. So we also want to define a couple terms that you may have heard before, referring to the stock market being either a bear market or a bull market. So these are kind of slang symbols to refer to when the stock market is experiencing a prolonged decline in overall value or prolonged appreciation or increase in overall value over a set period of time. So bear describes when the stock market is down, since bears typically attack by swiping down with their claws, while bull describes when the stock market is up, since bulls tend to attack by swiping their horns up. So you'll see this in the media more so as to kind of describe where we are with a particular market in a time frame. So again, bear is a prolonged decline in value, where bull is a prolonged increase in value, and it may be over a period of several weeks or years. Usually the kind of metric that the media goes by is that it either falls by 20% or increases by 20%. So bear is it falls by 20%, or bull is it increases by 20%, usually after a period of a decline. So bear markets also usually have investors that don't feel so positive. Maybe they feel negatively about where the market is, and sometimes investors will pull their money out during a bear market, which can also influence how long it's in a bear market. So some examples of bear market would be the Great Depression and the stock market crash that we experienced in 2008. With the bull market, some examples of bull markets would be the boom after World War II, and then the period after the housing market crash in 2008. Since we crashed, we had a prolonged increase over time. All right, so stocks or securities, I am experiencing some struggles here today, guys. Thanks for sticking with me. So security refers to stocks, bonds, money market funds, and other financial assets. If someone's referring to trading securities, they're typically talking about trading financial assets like a stock, a bond, or a mix of several assets, maybe several different stocks or bonds. So that is what we mean by security, and it's important to understand that as we go through here. We'll talk more about stocks later, but it is considered capital raised by a company selling and issuing shares of that particular company. So, and this type of investment represents an ownership in a share of a company, whereas bonds represent a debt that's owed to you. So we can talk about that a little bit more later, but there are two ways to earn income from stocks: capital gains, and dividends. So we'll talk a little bit more about what that means. So we also want to talk about the way you can lose money from stocks, but let's first focus on how we can gain some money. So capital gains mean the company does well, the stock's price goes up, you sell while that price of stock is up at a profit. And this is the primary way that you can make money off of stocks. Another way you can make money off of stocks is through dividends. So that is money that the company pays to their stockholders when it earns a profit. It's usually paid quarterly, semi-annually, or annually. It depends on the company and kind of the type of stock that you have. However, you can also lose money with stocks. And we'll talk more about risk of losing money later in depth. But essentially with stocks, the company might do poorly and the price goes down, and then maybe for whatever reason you sell at a loss. So that's called a capital loss. So it's important to understand these different nuances to gaining and losing money when it comes to stocks. So as I kind of mentioned earlier, bond is another type of security. If you buy a bond, you essentially become a lender, where the business or organization or even a government you buy that bond from must pay you back with interest when that bond matures or when the due date comes around. So this represents that debt that's owed to you. They may issue bonds to help with new projects or maintain ongoing operations, be it a company, an organization, a government. That entity must pay you back for the amount that you purchased that bond for or loaned them money for with interest. And so that is how you make money from it. Let's talk a little bit more about that. So again, there are capital gains and capital losses from bonds. When it comes to capital gains with bonds, let's say the interest rates go down generally. So the value of the bond goes up, and you sell that bond before it matures or before the due date comes around at a profit. There are also interest payments on some bonds. So this is the compensation paid by the bond issuer, be it a corporation or a government entity, to that bondholder. And if you're the bondholder, you get that interest payment. And then there's also the capital losses. This is how you lose money. Let's say the interest rates go up, the value of your bond goes down, and you sell before maturity at a loss. So that's important to understand kind of the risks and rewards there when it comes to bonds. So let's summarize the differences between stocks and bonds. So stocks, it represents a small share of ownership in a publicly traded company, whereas a bond represents a debt or an IOU that you own as a lender. With stocks, your relationship, that kind of entrepreneurial relationship where you're helping a company out by buying stocks, you own that stock and it's clearly defined. There are two different types of stock that you could kind of own, which is common or preferred. And I'll talk a little bit more on the next slide about that. And the value of a stock can go up or down. With bonds, they can be issued by, again, companies, municipalities, as well as like federal government, obviously. It has a maturity date for when you must be repaid, and it's often considered a less risky investment. So you are guaranteed, if you wait till maturity, to get that money back, so long as there's no craziness going on with the municipality or the government or the corporation that issued the bond. So let's talk a little bit about common and preferred stocks. So common stocks are obviously the most common. Shareholders are considered partial owners of that company and even have voting rights in some of the company's decisions, like the board of directors or even some corporate policies. And the earnings vary on when you're paid. So that's just the basics with common stocks. With preferred stocks, shareholders do not have any voting rights. They receive a profit typically before common stockholders, and they receive earnings at regular intervals. So those are the main things to pay attention to. All right, so let's talk about mutual funds. This refers to a pool of money provided by individuals or companies to be invested in a collection of stocks, bonds, and other assets. Money is pooled with those other investors, and a fund manager handles the buying and selling of investments. So we'll talk more about mutual funds, but here are some of the common types of mutual funds. You can have ownership, loanership, or hybrid mutual funds. So mutual funds made up of stocks would be ownership type mutual funds. Mutual funds made up of bonds would be loanership type. And then some hybrids include balanced mutual funds, target date mutual funds, and special sector mutual funds. Special sector might be like the mutual funds all relate to stocks in energy, or stocks and bonds in energy. So just think about that as you are listening to the rest of our show today, our webinar. So I'm going to hand it back over to Seisha to talk about your options for basic investing methods.
Thank you, Andrea. So we're going to talk a lot about the rest of the some basic investing methods for a little bit over the next few slides. So again, buckle up, we've got a lot to talk about. So what do you think you can invest? What ways do you think that you can invest? We're curious to see what you know. So waiting for the chat to go. Hear from my 125 plus friends. What are some ways you think you can invest? Real estate, home ownership, stocks, bonds, cash, alternatives, and mutual funds. Great. CDs. Okay. Index funds. 401k. 529 plans. Wonderful. Thank you everyone for your contribution. I'm going to keep going and we'll talk more about that here in just a minute. But these are just this is kind of like an overview slide of some of the things that we have kind of covered a little bit, but we're also going to talk about some of them. So, these are some of the methods of how to invest. So, working with a stockbroker, someone who sells and buys stock on behalf of a client. They do not provide any kind of other financial advice, and they just kind of concentrate on your investments. You do have to pay a fee for their services. Of course, there are financial advisors or planners, and this person is looking at your finances as a whole and advises you on a variety of financial products, including investments. So it's more holistic. We're talking about a financial planner. They help you also plan for, things like retirement, big purchases, planning for your children, those kind of things. Of course, we all know that there are tons and tons of apps out there, and we can't really recommend or endorse any of the apps, but there are a few out there that can help you invest, such as Robinhood, Acorn, E-Trade, etc. We'll talk more about those here in a little bit. And then, of course, you can buy and sell and manage stocks on your own. However, that's more for people who they themselves may be stockbrokers or themselves. So it's definitely not for beginners. Andrea kind of went over some of the vehicles already. She discussed stocks and bonds and mutual funds. Hedge funds are way more expensive compared to conventional investments. So we just put them in here just to let you know that. And then we'll talk a little bit more about exchange traded funds here in a few slides. But of course, we'll talk some more about some of these strategies later and have more of a discussion on those strategies here in a few more slides. So Andrea, if you wouldn't mind. So we think that, one of the first ways we think, if you're looking to hire a financial professional, just a quick reminder that financial professionals are paid one of three ways, and you should never really kind of be afraid to ask how a financial professional is paid. If they can't answer you, then you should probably find somebody else. They should be able to answer that question, but the three ways are, they are paid a fee under the assets of the assets that they manage. They might have an hourly fee. It could also be commission based depending upon that, or it could be a combination of all three. So some things we just tell you to look out for is look at different licenses, there's different fee structures. Like I just said, like, do they charge by how much assets you have brought in, or is it an hourly rate? And of course, look at if they have a fiduciary role. If they have a fiduciary role, basically the term fiduciary means that they're looking out for the best interest of you. They're not looking to make money off of you in a certain way. Like, they're just really trying to do what's best for the clients. And that's what a fiduciary is. Of course, you definitely want to interview quite a few of them, check their licenses. And then we do have a webinar. It's called Choosing a Financial Professional that you can watch, just so if you're looking, for the first time to do that. Of course, one thing we want to talk about was just like the different types of asset classes and allocation. Financial professionals focus on the different types of asset classes when putting together a portfolio for an individual. So just think of your portfolio as like all the cards in your wallet. That might work. And we're trying to put all the pieces in there together. And we're trying to put different pieces of this in there. So we'll talk more about diversification later, but you definitely don't want to put all your money in just one asset class. For example, if you put all your money in cash or cash equivalents, you may not be earning any kind of investment income, and you may be missing out on outpacing inflation. So you definitely don't want to put it all in your piggy bank or just in the bank earning, very small amount of interest. So there's something to be aware of. Asset classes are kind of created so that the assets under the class are treated the same way under tax law and government regulation. So just kind of a list of asset classes here are equities like stocks, fixed income like things like bonds and dividends from stocks. We have cash and their cash equivalents like CDs and savings accounts. We have other things like homes and real estate, which could be, risky depending on what you decide to do. Commodities are things like gold, grain, beef, and natural gas. Futures are things are what are considered contracts that are bought and sold. And it's price setting for future commodity sales. If you're not sure what a future is, don't worry about it because it's a little more advanced. And then there's also this idea of allocating into cryptocurrencies, but cryptocurrencies are really not regulated. So we just want to put that out there, is that they're not really regulated, and they're typically handled as a currency, just like cash. We also want to just talk about, for those individuals, if you suspect that your financial professional is committing fraud or is fake, you should immediately report it to the Securities and Exchange Commission or the SEC, or as Andrea likes to call it, the SEC, but I like to call it SEC. There's also FINRA, and then we also have the Illinois Department of Financial and Professional Regulation, and we do have Jake on here, if to answer any kind of questions that might be brought up. But I wanted to bring up some information about FINRA. Was that in 2019 they brought 854 disciplinary actions against brokers and firms for unethical behavior. Another one that we didn't really discuss, but I wanted to just mention, was that if you are working with a certified financial planner, that they also have ability to file a complaint with the CFP board, and you can find that on their website as well. So, okay. Another thing is, again, we talked about this a little bit earlier, but we can't really endorse any kind of app, but there are tons out there that can help you invest. Just a few that I'm going to mention are Robinhood, Acorn, E-Trade, SoFi, Zacks Trades, You Invest by JP Morgan, Merrill Edge, TD Ameritrade, Charles Schwab, and Fidelity. And basically, you have to decide what app works best for you and your lifestyle. There's, like I said, there's tons out there. So these are just some of the few that popped up. But, apps have tons of different functions, are you wanting to check on what investments you have, or you purchase through the app? Do they have a robo-advisor to help you with a portfolio and put that together? Are you looking to do active trading? Are you wanting to invest each and every day? And then, there's that roundup investing that Acorns does, if you spend a certain amount, there's a small percentage that goes toward that roundup investing. It's important to investigate, how is the app making money? And is there a fee with your purchases or a monthly fee? It's something to be aware of, especially when we're looking at, doing it ourselves or doing it for fun. Also, what information are they collecting? But how much, what info is also being shared? One of my colleagues from my graduate studies, he did a really great podcast called How Does Robinhood Make Money? So if you definitely want to check that out in the chat or save it for later on your smartphone. So it's a really interesting podcast to listen to. So we want to know, what would you want out of an investing app? I see the chat is going crazy. So what kind of things are you looking for if you are looking to invest with an app? We want to just know, like, what are some things that you're looking at? Easy to use, wonderful. Security, low cost, awesome. Low fees, teaches me what it's doing, educates me along the way. Okay, great. These are some wonderful. Privacy, access to a human too. I think that's important as well. That's a really great. Easy to mitigate or migrate to different platforms later on. That's important as well. But we'll definitely talk about that. So please keep throwing it in the chat. We want to hear from you guys. You know, that's why we have it all on. But Andrea, if you go to the next slide, please. So some things you can think about is that doing it yourself is definitely not for beginners. You can buy and sell and manage stocks on your own. However, this is more for people who they themselves may want to be stockbrokers. Individuals really want a low barrier to entry, and investing kind of seems like an old white guy kind of thing. But with the apps like the ones we kind of mentioned a few slides ago, they make it easier. This is just kind of my personal opinion about them, but when we're discussing DIY investing or doing it yourself, it's kind of a more fun opportunity. It's not a long-term, and we'll talk more about time horizon later. Another thing, you know, to consider is when we're talking about doing it yourself investing is like, do you want to do your own investing for things like your retirement or your kids' college future education? You know, these are things that you have to ask yourself. And typically you're bearing all the financial risk. Like there's no stockbroker to talk to, or, you know, investment advisor or financial planner to kind of like ask questions back and forth. So, you know, just being mindful of those things when we're talking about doing it yourself investing. Of course, when we're talking about investing, we also have to talk a little bit about investment strategies. Is that, you know, we have passive investing and active investing, and these basically sound what they are like. Passive investing, again, is what it sounds like. It's just a clue here that most individuals do passive investing. Even if your friends are like, I made $100 or $1,000 doing this. Most people, majority of people do passive investing. Even people with millions of dollars are passive investors. Shocking, I know, right? This means that they aim to maximize returns over the long run by not selling and buying securities very often. Active investors are what you kind of think of like on the stock exchange, like yelling to buy and sell. And this isn't really as common as it sounds. So most people is what they think of when they think of investing. This is what they think of. To be an active investor, I think you need to be deeply involved in your portfolio and know that there might be gains, large gains and large losses as well. So just some things to be considered of when we're talking about investment strategies. Of course, one of the things that we like to talk about with investment strategies are exchange traded funds. So Andrea earlier mentioned mutual funds, and mutual funds are kind of a lot like, exchange traded funds are a lot like mutual funds. The exchange traded funds combine features of a mutual fund, which can be purchased or redeemed at the end of each day. So you purchase a mutual fund, that's the price for it that same day. But exchange traded funds kind of fluctuate all day long. So the price at 9 o'clock this morning for an exchange traded fund is going to be different than at noon or 2 o'clock in the afternoon. So that's just one thing to be aware of. But like mutual funds, they have a lot of pieces inside of them. There's lots of things like different stocks or bonds inside that exchange traded fund. Like I said, they're very similar to mutual funds, except basically they're just traded all day long. Another thing we wanted to talk about is this hot topic of fractional shares, because we think that that's important to talk about. So fractional shares are what we're seeing a lot with apps, some of the apps that we did discuss, but you basically are purchasing a portion or a very small portion of the stock. So for example, we looked at what Google was on Friday, March 5th, and it closed at close to $2,100 per share. But you can invest with an app or any other thing, and you can do as little as $5 into Google on many apps or investor websites. And so if you did that, you would receive approximately 0.00247 shares of Google. So you get to be a part of the pie. And that's actually what a lot of investment firms are pushing it out as, is that it is a piece of the pie, that they are able to, you can get that piece of that awesome stock that you've been wanting to have for so long. Another thing is that it's not really easy to redeem once it's purchased. So you have to work with a certain broker to redeem the cost of it. Typically it's whoever you bought it with that you want to then redeem it with, just because of that's how it was purchased. But if you're like moving it from, one platform to another, it might be way more difficult. So just some things to think about, especially when we're talking about looking at apps and then looking at purchasing fractional shares. So another thing we wanted to talk about, and this typically has to go with like the GameStop piece of short selling, but a short sale generally involves the sale of a stock you don't own or that you'll borrow, for when it gets purchased. But short sellers believe that the price of the stock will fall. So they're seeking to kind of hedge against potential price volatility in securities that they own. So if the price of the stock drops, short sellers buy the stock at that lower price and they make a profit because they're like betting against it, right? Like they're betting that the horse is going to not make it to the gate, I guess is a good example. But if the price rises, the short sellers incur a loss. So like, let's say the horse did get to the gate and they bet against it, they wouldn't make any money off of it. So just another quick example I wanted to have come straight from the Securities and Exchange Commission, from their investor.gov. Just a quick example of if an investor believes there's a decline in the stock price of company A is trading at $60 a share. So the investor borrows shares of company A stock at $60 a share and immediately sells them in a short sale. So we're looking to sell short, okay? So later, company A's price declines to $40 a share. So it was $60, now it's $40, and the investor buys the share back on the open market to replace the borrowed shares. Since the price is lower, that investor, maybe you, profits on the difference. In this case, it's $20 a share. So interesting enough. Another thing is that however, if the price goes up, like I said, the original price, the investor loses money. So if the stock price increases to $80 a share, the investor must buy the shares back on the open market to replace it and then has a $20 loss. So this is just one thing we wanted to point out, is that short selling is very risky. And unlike a traditional, long position where we're investing, when risk is limited to short selling, back up. Shorting a stock leaves an investor open to the possibility of unlimited losses, since a stock can theoretically keep rising indefinitely. So that's basically what happened with GameStop, is that people were hedging that they were going to continue to lose. And then the price shot way, way up. So the investors thought the horse wasn't going to make it to the gate. And they bet against the horse. And then the horse was like, not only did I win, but I won like really awesome. And I ran around the track 3 more times and beat the other horses. That's what kind of basically happened. So we just want to make that clear that short selling is an important topic and concept to understand, but it is very, very risky. So, lots of information. Okay. So let's
I really appreciated your horse analogy there.
Oh, thank you. I hope it really helped.
Very good.
Okay, good. I hope it helps, because that's like, that's why I think about, I don't know, I was thinking about horses and racing and all of that. So we're gonna talk a little bit about risk and reward, because honestly, that's what investing is being able to understand our risks and our rewards. So yes. Okay, great. So as anything in life, there's the risk and reward with all that we do, like anything, whether it's investing or losing money or, losing weight or having a child, all these things have risk and rewards, right? But when we're talking about investing, we'll talk more about purchasing power risk, but basically we want you to know that your long-term investments can be eaten away by inflation and reduce, how much you can purchase. Well, again, we'll talk more about that in a second. Another piece of investing in another country could potentially reduce your power to purchase assets because of the exchange rate, right? You know, we know that how much a dollar is worth here, but, you know, when we look at other countries and trying to exchange that rate, you know, sometimes we get more money by going someplace and sometimes we get less. Another thing is we want, you know, the market moves on a daily basis, depending on your emotions and, you know, what individuals feel. Like it depends on how things look when we talk about market volatility. And then there's also this inherent risk of any business sector. You know, if we talk about like a few bad Tesla cars and they catch on fire or something, or they blow up, or, you know, products could make that whole stock price fall. And then of course there's that tax liability on short-term gains and long-term gains and even losses. But there are rewards for individuals. You know, investing in the stock market helps us to stay ahead of inflation. You can help build income and improve your net worth. And you can create wealth for yourself and future generations, which is really nice. And of course, you can use compound interest and the time value of money to help you look for long-term rewards. So one thing we wanted to talk about, inflation risk is another word for purchasing power risk. So as time showed, you know, prices of items have greatly increased. So we look at things like eggs or even milk to kind of look at this idea of inflation. So the price of milk in 2000 was $2.78, which again, doesn't seem too bad like a price. In 2020, it was $3.32. So there's a 54-cent difference here, and that merely might not break the bank. This example just kind of shows like how inflation keeps rising, and so does the cost of goods sold in the United States. Inflation, for those, you know, who just need a better definition, is it's a general upward movement of prices. And so inflation reduces purchasing power. So like, again, with the milk, again, that's not a big difference here, but if we're talking about things like gold or silver or other things, we have to look at, you know, what it is in the long term. Purchasing power risk isn't much of a problem in the short term, especially if you're looking at like a short time horizon of maybe a year, 3, 5 years. But for long-term investments, it's basically your worst enemy. And so that's why we want to discuss it. Another thing to be mindful of is that we just want to make it clear to like our webinar listeners that the stock market is not the economy. The stock market can be going up and down, or it can be going up and up and up, while the economy is continuing to do poorly. And as the slide says, early in the pandemic, we saw a lot of buying and selling going on in the stock market. Trust me, my partner is a financial planner, and the amount of stock trades and positions that were being moved in those first 3 weeks of the pandemic were insane, crazy. He was so busy. He didn't have time to eat lunch some days from his information, you know, from his clients and what they wanted to do, you know. But there was lots of buying and selling going on in the stock market. While we saw record rates of unemployment, you know, we saw some of the highest rates of unemployment we've seen in years. So we just want to make sure that, you know that there are many factors that go into the economy. It's not just how the stock market is performing at a certain time. It's like all these pieces of the puzzle we're talking about, you know, the stock market and the economy as well. So another thing that we wanted to talk about is knowing your risk tolerance. It's a really important concept to know. And, you know, I asked this question because I think it's important to think about is, are you the person who would jump out of a perfectly good airplane? Or are you the friend who's waiting patiently back on the ground? There's research that shows that younger adults and men tend to be more risky when it comes to investing. But by taking the time to take this quiz and know what your risk tolerance is, you know how risky you can be with your own investments, whether that's retirement or even an account that you use for fun on, you know, on the side. So please do take this quiz from the University of Missouri. Check out their risk tolerance. You know, this will help you when you go to meet with a financial professional or even doing it yourself. So next up, we're going to talk about a little bit about time frame matching. You know, how long do you have to invest to reach your goal is kind of what you'll determine like what you should invest in. So my husband and I were having a conversation about this, and we were talking about like, okay, well, I would like to, you know, put some money down into the stock market for a ring for my partner for the next year. You know, that's going to look very different from planning for retirement. So we just want you to be mindful of like, okay, what am I using this money for? How long am I going to be investing it? You know, and the other piece again, it was that risk tolerance is looking at like how much, how risky can I play with this money basically. So we just want you to be really mindful of time frame matching and looking at like, okay, well, I only have a year to play with this money. We can be as risky as you feel, or maybe not, just it depends. So continuing on. So one thing I wanted to tell you about is this concept of the time value of money. And some individuals in personal finance feel that time value of money is probably the most important concept when it comes to personal finance. But this is the method where you can compare cash flows across time. So let's say you start contributing $200 a month to an investment vehicle. And it can the time value of money calculation can help you figure out what that future cash flow is for the future, or if you had a lump sum, what it could be today. So in this example, it's kind of showing that there are different interest rates here. You know, there's the light blue line, which is at 3%, the 6%, and the 9%. It just is really just showing you, you know, how long putting $200 away, what that looks for you over 40 years with how much savings that you will have. You know, we just want you to show, again, this is a time horizon thing. Time value of money is there to kind of help calculate what money you're putting away today will look like in the future, given a certain interest rate. So another concept to be aware of is the rule of 72. So it's just a quick calculation. And basically you do 72 divided by the interest rate. And this is the number of years it'll take to double your money. So if you had an interest rate of 3%, it'll take 24 years. Ooh, that's a long time to wait. If you had an interest rate of 10%, it would take 7.2 years. So not too bad. And if you found an interest rate of 12%, you know, that's 6 years. So that's why we're talking about looking at the stock market and investing, you know, we're looking at, you know, again, our risk tolerance and how long do we have to invest for. So there are, of course, some ways to limit your risk. And this is kind of just like a summary slide of the things I'm going to talk about here in just a second. But we're going to talk about diversification here in just a minute, some more about asset allocation. I think Andrea talked a little bit about dollar cost averaging, but I'll talk more about it as well. And then we talked about time frame matching, but we'll also talk about indexing. So diversification is kind of this idea that you really shouldn't put all your eggs in the same basket. I also want to steal Andrea's example about diversification we had done on the podcast with Jake and Nikki from IDFPR. And she told us, and I might have her talk about it too, but you know, this idea that when you're in an elevator and there's only one cable, you know, if that cable snaps, then, you know, you'll plummet to the floor. But if we have multiple cables, so multiple pieces of, you know, different stocks, different bonds, mutual funds, maybe we decided that we want to look at ETFs, you know, all these different things. We have all these different cables on the elevator. We feel much more safe and much more diversified. And if one cable breaks, when there's 100 cables, we'll feel safer than if we just had one. So
I think you did that perfectly. You described it perfectly.
Great. Awesome. Okay, great. So we just want you to be mindful of it, that, you know, a lot of people get really excited when they want to invest for the first time, and we totally get it. We are excited for you. We want you to invest. We just want you to be mindful of making sure that your elevator is not plummeting to the ground. Next up is asset allocation versus diversification. So we just talked about diversification, but not only are we talking about the different types of asset classes, but you want to diversify in the stock, bond, or even cash equivalent portfolio. So we're trying to diversify over many different types of eggs or many different types of cables in our elevator. You know, we don't want to put everything into stocks. You know, we want to put some bonds in there, maybe some cash equivalents, some other things. We also want to look at, okay, when I'm looking at my stock portfolio, is it diversified in the different sectors of business that are out there? Like, you know, whether it's pharmaceuticals or energy, or maybe you're like really into, you know, agriculture, or maybe even personal finance. So we just want you to be mindful of like diversification happens in lots of places. And that's why we always, while we want you, if you are interested in doing it yourself, we would be happy for you to do that, but we also want you to look at thinking about other individuals as well. Whew. Dollar cost averaging. Dollar cost averaging is kind of what it sounds like. I purchase a mutual fund piece every month for $100. The prices change, based on the day, and it depends on how many shares I can buy. So this is just investing the same dollar amount on a regular basis over an extended period of time. You have more shares when the prices are up, or when the prices are down, sorry, and fewer shares when the prices are up. And this just does help reduce that market and exchange rate risk that we talked about a little bit earlier. So just some things to be mindful of is that dollar cost averaging is a good way to kind of reduce these things. And of course, there's index investing. And these are like mutual funds, they're kind of a passive. So we talked about passively, managing our funds. So instead of going active, so the goal is to match performance of like a benchmark, such as like the S&P 500. And again, this reduces market risk and business risk. It tracks a market index, like I said, like the S&P 500. And there's a couple we'll talk about in just a second. But our goal is to maximize returns over the long run by not having to buy and sell very often. Again, we want to be mindful of, how often are we doing those things, because it does incur a fee. Okay. Of course, I wanted to show you a quick graph of the Dow Jones. It's like, Andrea, if you want to push the next.
Can I just talk a little bit about what an index is?
Oh yeah, go ahead.
I'm not as advanced as Seisha is when it comes to investing. An index is just a collection of different companies or stock companies that provide stocks with similar traits. So one of the other market indexes is called the Wilshire 5000, and it includes all stocks that are in the US stock market. It doesn't include any international ones. And that one only has 3,500 companies, which again leads us to kind of reiterate that the stock market is not the economy, because there are many, many, many more companies that function within the US kind of infrastructure that are not on the stock market. And that's just one example of that. But index is a collection of stocks with similar traits. And that's what I just wanted to kind of reiterate. Okay, now back to the Seisha show.
No, thank you. I appreciate it, Andrea. Thankfully, the Seisha show only has 2 more slides. So we just want to show you that this is kind of a graph of the Dow Jones Industrial Average between March 6, 1981 and the last Friday of March 5th. And you can definitely see there's a lot of volatility going over the past 40 years, but generally the market's gone up. So that's a good thing. We want to, just be really, let you know about that. But on the next slide, this is kind of the graph of the Dow Jones Industrial Average compared to 2 other indexes, the S&P 500, which is probably what you're more familiar with, and the NASDAQ. So there's lots of different ways to kind of look at the market and look at, what is going on. But we just wanted to let you know, like, what does it look like? What does the investment piece of it look like? How up and down does it go? You can see those peaks and valleys and see how, we're continuing to rise. So I'm going to hand it over to, go ahead, Andrea. I'm going to hand it over to you. Yeah, go ahead.
Thank you. With these different indexes, it just shows that if you only pay attention to one index, it might perform a little bit differently than the other indexes that are available, even though they all generally go up. All right, I'm gonna take over and close this out. So you're here, you want to get started with investing, and we produced a lot of information for you to kind of mull over and synthesize, but I want to wrap it up in like a nice gift basket and hand it over to you. So it's important when you're thinking about getting started with investing that you have a financial plan in place before you actually take the first step. And if you've been around very long with our Get Savvy series, which we've done for many, many years, and the recordings are all available on YouTube, we talk about financial planning a lot in all of our webinars, but we're going to talk about it with the idea of starting investing with this one. So obviously you want to set your own financial goals. You want to assess what your financial situation is. You want to assess how many debts you have, what your assets are. Some people may look at this as calculating net worth so they can kind of see where they are with their situation. You also want to make sure that you have emergency savings available before you start investing, because if you are investing and you've made a commitment to invest a certain amount every month, you don't have any emergency savings, and your car decides to, not work anymore and you need it to get to work, that's a financial risk for your well-being or your job or all kinds of things. So you want to make sure that you have that emergency savings in place. Most investment professionals would also say that paying down high interest debt before you start investing is a good idea as well. You want to look at the time horizon you have to reach those goals that you set, and make sure to research options, investment options or strategies or tools that will help you reach those goals within that time horizon that you're looking at. And then you also want to consider your risk tolerance and what your limits are, both emotionally and financially when you start investing. So we're putting lots of things in the chat to help you with creating your own financial plan so you can get started. I also want to talk a little bit about retirement planning, since it's one of the biggest goals and for a lot of people and why they have to invest. So it's a very important long-term goal. I've heard some people say, oh, I'm just going to work until I die. That's my retirement plan. It's not a feasible plan because most people aren't able to work as they age. Things happen to our bodies and our minds. So we need to plan for retirement from a safety aspect and a well-being aspect, as well as a having fun aspect. It's also important to recognize, especially in the United States, that our access to retirement tools varies tremendously depending on your individual employer, what industry you're in or you work in, or what sector you work in. So public access, if you work for a public company or government entity versus working in private business sector, your access to retirement planning tools varies pretty tremendously. There are things that you can access outside of an employer, like an individual retirement account, or even like in the state of Illinois, you can look at something like Secure Choice as an option for helping you to plan for retirement. So I know we have people from other states. I don't know what's in other states that may be an option for retirement planning, but you might do some research and check out, if you're in another state, what your options are. So there's two main types of retirement plans that I do want to just touch on. There's employer sponsored, which I talked about a little bit, and individual retirement accounts, IRAs. And then there's defined contribution and defined benefit. So these are the big buzzwords that we want to kind of define. Defined contribution are things where it's a defined amount that you are contributing as an employee. You may or may not have an employer add to that contribution, but then we kind of rely on the market to define how much we're going to get at the end, how much compound interest and gains that we get out of that over a long period of time. Whereas defined benefit is the employer has defined how much you will get when you retire. Those are much less prevalent now. Things like pensions are defined benefit than they used to be. So most plans are defined contribution, and there are lots of different letters and numbers to remember for these. But one of the big ones is 401k is a defined contribution plan. There are also things like 403Bs that are defined contribution or 457s. So just think about those different types as you're making your retirement plan. You also want to think about the tax benefits of different plans. So a traditional,
Andrea, we just lost you. Did you
my
hit mute?
power just went out and it came back. So I'm glad I'm back. Whew, that was scary. Is everyone okay?
Oh no, it was scary.
Okay, so where did I lead off?
You just started to say traditional.
All right, so traditional tax plans or tax deferred plans would be things where you, let's say you have a traditional IRA and you have tax benefits for contributing to that IRA up to a maximum amount. And then when you retire, you pay taxes on the distributions from that fund. Whereas a Roth, you contribute to the plan after you've already paid taxes on it. So you don't get any tax benefits right now, but when you retire, you don't have to pay taxes on the distributions from that fund. Whew. I'm glad that we could recover from that, everyone, and everyone's safe. So when you're thinking about your retirement goals, there's a rule of thumb that you need 10 times what your starting annual salary was by the age of 67. Depending on who you talk to, that might be a range of 8 to 12. I think it's important to consider what you want your post-retirement lifestyle to look like, especially if it's different from what your current lifestyle is. So you can estimate what your financial needs are going to be and try to match your investment portfolio and goals and that time horizon to what you need in order to retire. All right, so we have talked about tons of different things today, and I think it's important to know we have other educational opportunities for you to learn more about these different concepts that maybe we just touched on, and you didn't really get enough out of it. You want more. So we have some podcasts that we're putting in the chat, as well as some YouTube videos of previous Get Savvy webinars that we've done that you can check out, including Budget Hacks, What's Your Job Worth, talks about retirement plans much more in depth. And choosing a financial pro is really helpful for if you want to choose a financial professional to help you out with all of your personal finances, or if you just want to do investment with them. All right, we're going to try to wrap this up quickly. What do you think the minimum amount you need to be able to invest each month? What do you think it is? $50, $50 grasshoppers, $200. All right, so it's $50, not grasshoppers. 700, 10 to 15% of income. Oh, all kinds of Benjamins. All right, so according to the IRS, if you are making contributions to an individual retirement account, there are no minimum requirements. There are some maximum annual contribution amounts that you have to pay attention to, and it varies by tax year. So you just want to pay attention to how much you can contribute without having tax complications if you are using an IRA. Some mutual fund companies that sell IRAs may require a minimum contribution of 25 to 50 a month. No matter what you're using, you want to watch for fees, and you also want to pay attention to that time horizon that we talked about. If your goal for retirement is to save, I don't know, $1 million, you need to match your contributions to the potential to make that $1 million. If you're only contributing $5 a month and you are 20 years away from retirement, it's unlikely you're going to meet that goal. So again, that's why goals are so important when you're deciding on what investment vehicles to take advantage of, as well as how much you're going to be able to contribute towards that goal. All right, so some ways you can get started with investing. You can practice with stock market simulations, things like paper trainings, using the stock market game, or a virtual stock exchange. And you can even make it into a friendly game with your colleagues or friends where you're not putting up money, but you are getting some practice on how to manipulate kind of or navigate that stock market. You can work with a financial professional, which I know that we've talked about a lot, but people have are paid to do this professionally and taking advantage of their skills and expertise, and education and licensing can be really valuable to helping you reach your goals. And you can look at retirement plans that are available to you, like look at your employer, see if they have different types of retirement planning tools or investment tools that will help you reach your goals. So again, let's wrap things up. You want to start with a plan, which you've likely heard us say pretty much every webinar if you've been here before. Remember, there are many options for investing and their benefits do vary quite a bit. We've talked a lot about risks, but investing is the best way to stay ahead of inflation so that your dollars can buy more in the future instead of less than today. Again, risk is an important consideration when investing, not just with market volatility, but also with those other risks we talk about, like business risk, inflation risk, and exchange rate risk. Again, you can mitigate those risks within the strategies you choose for investing. Passive investing strategies like index investing combined with time can help you a lot over long term. The time value of money gives younger investors an advantage. So the younger that you are when you start investing, the more time that you have to let that money grow or even recover from market volatility. And as always, you want to report suspected fraud when you notice something fishy going on, especially if you're hiring a financial professional to help you make decisions. So our next webinar is on student loan repayment. If you haven't checked it out or registered yet, please go ahead and do so. It's on Wednesday, April 14th, right before taxes are due. And we will stick around for questions, but I know we're a little bit late on the hour. So if you have somewhere to go, lunch plans to get to, go ahead and take care of that. And we want you to stay in contact with us. This is all of the organizations that partner on the Get Savvy, Grow Your Green Stuff webinar series. So we want to thank all of our co-hosts today from Loyola and IDFBR and Illinois Extension, as well as DePaul University.